Greetings from Lexington Wealth Management. We wish you a very happy new year and looking forward to great returns in 2017. I'm joined today by my colleague, Betsy Lavoie, who joined Lexington Wealth Management last year as a wealth advisor and senior member of our investment committee. We want to use this opportunity to reaffirm our investment approach and discuss the 2016 results from the investment side of the portfolio. Nearly all portfolios have an allocation to equity and equity-like investments that are meant to grow over time, but will exhibit a fairly moderate or sometimes excessive amount of volatility depending upon what's going on in the capital markets. Nearly all portfolios will also have an allocation to bonds and bond-like investments that will exhibit greater stability over the long term and a greater source of income than equities. Our starting point in building the equity portion of client portfolios is the global equity market, which predominantly is made up of the US, Europe, the Far East, and the emerging markets. Adjustments are then made to that starting point based on current market valuations and a host of risk factors. So Betsy, perhaps you could pick it up from here and discuss the equity results for the 2016 year.
Thanks, Kim, for the intro. I'm really excited to be part of the Lexington family and here to talk about how the markets performed in 2016. The markets were really up and down last year. There were quite a few surprises. Earlier in the year, we saw fears about China and falling oil prices, and then Brexit, which was certainly a surprise, and the election as well later in the year. Riskier asset classes broadly outperformed last year, and within equities, U.S. small cap companies actually did the best as investors saw opportunity for corporate earnings to improve domestically. U.S. large cap companies did well too, and the S&P 500 actually made new highs in 2016. Emerging markets did very well, but they did sit on the sidelines a bit during the fourth quarter when other asset classes rallied after the election. Developed international markets, unfortunately, just eked out a positive return. And overall, global equity markets returned about 8.5% for 2016.
So let's move to the fixed income portion of client portfolios. Our starting point in building the bond portfolio is to strike a balance between the core high-grade bonds, that's both taxable and municipals on the one hand, and credit strategies, including high yield, bank loans, emerging debt, and convertible bonds on the other hand. So Betsy, perhaps you could discuss the bond results for the 2016 year.
Thanks, Kim. Last year, credit markets like high yield and bank loans and emerging market debt really outperformed relative to more traditional bond markets like U.S. government securities, U.S. corporate bonds, and municipals, which had low single-digit returns for the year and really performed in line with their yields.
Thanks, Betsy. As a good summation of the 2016 year, I want to make a couple of points before we close. Last year in 2016, it was a year that diversification really worked. We've been harping on the need to keep portfolios allocated across nearly all the asset classes in order to create a smoother ride in your performance. And last year, there was a great divergence of performance between markets in the US and markets outside the US, and it was really helpful to have an allocation to all of it. The US market actually outperformed our expectations. The developed markets internationally underperformed our expectations, and the emerging markets, which performed quite well, performed in line with our expectations. So it was good to have an allocation to all those asset classes. The second big point that I want to make is that last year was another great example of the need to have staying power in maintaining your allocation. There were some big events. The Brexit event in the middle of the year was relatively big, although most clients were able to withstand the gyrations that caused. But more importantly, the election in November was really a great tipping point where we heard from many, many clients about how scared they were with the outcome of the Trump presidency. And, as it turned out, markets rallied as a result of that. Now, we didn't predict that, but it was important that clients stayed with their portfolio allocations in order to reap the benefits of whatever came their way, because it's very, very hard to time markets, particularly from an emotional perspective. So congratulations for having that staying power, and we hope that 2017 year is a great year for the capital markets. And should you have any questions, this is a really good time to reach out to your client advisor to update them on your personal plans and also to review both the portfolio historically and also to discuss our ideas about portfolio allocation in the year ahead. So thank you very, very much for your time.